Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook and be your host for about the next let's go 30 minutes today. We've talked about the introduction of a new strategy that I guess we don't look at usually more longer term options. Inside a portfolio. It's the beginning of a new year. We started off by looking at a deep in the money call in NVIDIA. And now we're going to look at a trade in a financial stock. The one that I picked today is JPM, JP Morgan. And I like Goldman Sachs a little bit better, but it's a lot more expensive. But I like them both. So I'm going to go with the JPM. All the financials are down a little bit today. So we're going to take that opportunity on the weakness to get in and get long on JP Morgan and some of the other financial stocks. And then we're going to also look at a good industrial stock that I've talked about before and done a few trades on, which is FedEx. And we're going to get long FedEx. Also, strong earnings last quarter. As we head into the actual earnings season here, it's not that far away. So I'm going to start. Let's go and we're going to see earnings here in JPM fairly soon. And we'll go to the Tradier Pro software. NVIDIA, once again, just kind of hanging. NVIDIA is just hanging out, I guess, right at the 190 level. Definitely in a period of consolidation. I don't mind where our position is at. And I'm not going to look at these positions every single day, right? I'm going to wait for earnings to come through probably on the banks, and then we'll sell a call against the JPM position. And we'll do some things like that, and we'll periodically check them out. But I actually have these positions inside the paper trading portfolio. And if I remember to log into the paper trading portfolio, we'll always be able to check them periodically. All right. And one of the great things inside the paper trading portfolio now that the company that Tradier is using to derive value is you can actually look at SPX option contracts, and we can trade our zero DTE butterflies if we like. There's other different things, but bottom line is even the VIX index, we can actually look at paper trades too inside this portfolio. Now that we're using a derived value where we're not getting paid or not having have to pay fees to the exchanges that have these single listed options anymore, which the fees are outrageous. I have to admit, I've been in this business for a long time and I don't know how the exchanges get away with charging so much just for a quote. But with that said, and because of that, I still like a lot of firms have got rid of the Russell 2000, which is one of the most expensive quotes, the RUT index. And I'd rather trade IWM anyways. Okay, so which is the ETF? I digress. Where am I looking at? I'm looking at FedEx. No, I'm looking at JPM. Earnings date is 1/13. So next week is earnings, and JP Morgan is usually I always kind of look at them as the start of earnings season. There's a few companies ahead of it, but the financials are always leading the way. And that usually means like there will be 5 or 6 major banks / financial companies that will be announcing next week. And here's the move that we see up. We definitely saw a breakout here. This is where it would have been solid to buy JPM. And that's why I want to come back, and we're coming back to that range. So right through here, we see that period of consolidation. Look at my crosshairs all the way across from here to here. There was a breakout. That would have been a good potential buy. Now we came back and retested. Back up again. Now, if we come back and we test this area and we don't bounce and start making higher highs on the way up, that would be a bad thing. But once again, a longer term outlook, I still believe that stocks that are in the investment banking business like JPM are leaders in that segment, and that deals are going to get done in 2026. And I do think that that's going to help, not to mention the fact that we're seeing a good move in the yield curve as far as the banks are concerned. Shorter term rates are coming down, longer term rates are going up. Not good for home buyers in that you're not really getting a break on your mortgage, on your 30-year mortgage. But with that said, the banks, that's a good ratio for them. So JP Morgan, here we go. Deep in the money call, we're going to stay with that same expiration date. So we're looking at the June expiration, and that's the expiration that we used in NVIDIA. And so we see that this is June 18th of 2026, 162 days out at this point in time. And quite simply, we're going to go down and look for an 80 delta option contract. And once I like to chase open interest, especially in these deep in the money options. Now, it doesn't mean the open interest is going to stay there, but I'm going to have to pay a little bit more for this, about $3 more. But if I buy the 81 delta, we got open interest of 1,287. The 87 delta 248. So I'm going to lean to the 81 delta. I kind of like the price of the 79 delta, but you get what you pay for. You're getting more intrinsic value. You're getting $5 more worth of intrinsic value. So this is the option we're going to buy. And once again, if you're now inside the paper trading portfolio, when you send an order, you're not going to get representation in the market. And I talked about this more than once, and I think I'll talk about it every time we send an order. I did do the 290. Okay. One of the hardest things about buying deep in the money options is trying to deal with bid-ask spreads. So you have to have very liquid underlyings. And the bid-ask spread is an issue. And when we're doing it in the paper trading platform, we're not going to get representation, right? In that, if we send an order to the floor and you're the best market on the bid or on the ask, if you're buying, it would be on the bid, because that means if someone's selling, you're willing to buy it from them at that price. So you have to work these orders and try to get decent fills, but you're not working at the midpoint when you're doing single options. You're working somewhere between the mid and the ask price. All right. So I'm going to do what I did in NVIDIA, in that we got $3, a little over $3 between the bid ask. Midpoint is 47.15. So I'm going to come in the middle. I'm going to put it in at 48, but I don't think the paper trading platform will fill it there. But that's what I would do. I would send this order. We're going to buy one contract, similar price as to the NVIDIA contract that we put out. We're talking about $48 or $4,835. If we buy it at 48, we would. Yeah, it didn't fill. We're going to have to bump it up to the ask price because of the paper trading platform for sure. But let's do the percentage, right? Total cost to buy one option contract, $4,835 if we hit the ask. Total cost to buy 100 shares of JP Morgan, $32,478. $32,478 to buy 100 shares. That will be about 14%. That's not that bad at all. So we're not paying the juice that we had to pay for NVIDIA, and that makes sense. So volatility is a little bit lower in the financial than it is in the AI stock, and so 14% is the maximum that we can lose over the next 6 months. If the market comes down and hits the 290 level, we're going to get out. Our biggest risk here, legitly, our biggest risk is dealing with bid-ask spreads and trying to manipulate that. And I've said this when we did NVIDIA, and once again, I will repeat myself. If it wasn't for wide bid-ask spreads on deep in the money option contracts, I don't think I would ever trade stocks. I would just use this strategy. And you put it on, you got the limited risk on the downside. You don't need a stop order. You don't need anything. The market, the maximum you can lose is what you paid for it. And on the way up, you take your profits whenever the delta gets to 1. And then you roll the position into a new position and you hold that position. Market comes back down. Once again, maximum you can lose is 14. But if it ever comes down and hits that strike, I just get out. Or you could say, I'm going to get out when I lose half, right? So we're paying $48. We're getting a little bit more delta, but we're chasing that open interest, 81.67. Get a little bit more. The bid ask is 22.5 by 23. If the market went from here to here, right? If the market dropped precipitously from 325 to 290, you would expect the 290 to be trading for what the at the money option contract is trading for right now. So you'd basically be cut in half. And on the way down, we lose less than on the way up, but we still have time premium. We still have time decay that we have to deal with. And here we're seeing that we're paying for $12 of extrinsic value. I don't plan on holding it for the entire 6 months because that $12 would also be at risk. We will probably sell some shorter term options against it, turning into the fig leaf, which is the strategy I named inside my book, The Options Playbook. And that's the way that we would take that approach. All right, so here's our order that's in here. Here's our portfolio on NVIDIA. We're down $137 on NVIDIA at this point in time. And we're buying to open one of the JP Morgan. And then let's do one more. Let's add one more order today. And I'll try to figure out kind of like UNH. We've been talking about UNH for a while. That'll probably be the next sector, and we'll add that position next week, I think. But UNH has had a good couple of days. Actually, we're not back to the top of that channel, but we had the golden cross where we had the 20-day crossing over the 50-day, and we came up and we bumped up against the 200, and we've kind of pulled back from there, but had 3 strong white candles here, or up days, and now we're down a little bit with the general market. I guess people are finally realizing that we have geopolitical concerns, I think, overall. That's where we're at. UNH. Okay, let's do FedEx. Let's take a quick peek at the FedEx chart. That's also, now this is a perfect chart as far as, it's amazing that it's FedEx, right? This big shipping company. But with that said, look at this, kind of looks like this should be an AI stock, right? We got this is a nice slope if you were looking to go skiing. All the way up, solid moves to the upside. Strong move here, 200-day. The only thing that is a little bit concerning is that we are getting a little bit far away from the 200-day moving average, but we got the 20-day or the 50-day and the 20-day all in a row. That means we got our ducks in a row. So we got a strong upward market. Like I said, we're just getting a little bit overextended. Don't mind actually selling a shorter term call against this position. FedEx to me is a little bit more predictable. Selling a call in NVIDIA versus selling a call in FedEx, it's a lot easier to try to manage that short option contract as opposed to looking at the NVIDIA call, mainly because of gap openings. FedEx, you're not going to get as big, and I say that as I look at this big white candle, as big gap openings as we are as we do in NVIDIA and some of the AI stocks. So let's go deep into money. Here we go. Options grid, FedEx, and then we'll fill these trades and we'll call it a day. Oh, we filled. Nice. Okay, so the market came down a little bit. It said the paper trading app actually filled it at 47.20. Interesting. Let's go back and take a peek at that JPM. And I realize that my picture's right in front of the alert, but not that big of a deal. Over here in this corner, well, there you go. That works. Thank you. It shows that trade filled right at that price. 48. Yeah, the market didn't really move much, but it gave me a fill at 47.20, which is just above the midpoint there. All right, 290 JPM. All right, let's go back to FedEx. Let's continue doing what we were doing. Now we're going to go deep into money. We're looking at an 80 delta. Ooh, this is tough. Got 10-point strikes. That's $4 spread. This is a $3 spread. That's 83. That's too high and that's too low. June, 162 days out. Yeah, let's do the 280. Don't want to pay an extra $7. Yeah, let's look at this one. We do got the June expiration though, which is nice. 162 days out. We got 10-point strikes, and I do wish that the exchanges would limit the strikes. I don't. Liquidity is still an issue in options. It's not a huge issue, but you look at this. This is a $3 wide spread. That would be the fact that if you had less strikes and the spreads got tighter, I would be okay with that. I'd rather trade something that's much more liquid than have more things to be able to trade that aren't as liquid. But here we go. Let's buy this one. Oh, I'm putting in too many contracts. 1, 2, 3. Okay. 41.58. So where I would probably come in? Yeah, once again, 42.25. Splitting the difference between the two. That's probably, if I was working this order right now, that's where I would send it. And we're going to buy at 42.25. We're going to send that to the market. And that order has been sent. Remove the picture for a sec. And you see that one order over here in this corner is at 280. Let's go look at the orders then. January 13th, they just paid out their dividend. Yes, Kurt, thank you. You can share that if you want, but we did mention that. And JP Morgan is going to be the first in that series. And I did want to get into this position ahead of that earnings, but vol is not that horrible. We saw that it's only 14% of the total stock price. So I don't mind owning some financials going into earnings. And we'll probably, when earnings come in the financials, Kurt, we'll probably look at a few earnings trades in Goldman and JP Morgan and some of the other financials in particular. Okay, got one open trade. Here's our portfolio. And it does highlight that too. I should emphasize, if you put your mouse over this, it's showing you that JP Morgan has earnings. I think it's within probably 7 days that this little earnings report comes up. Not 100% sure that when this pops up, I think it's 1 week away. It may be a little bit longer. Okay. And then also in the options grid, highlight a couple of things. And this is awesome with the Tradier platform. First of all, it shows you that you got an open order here to buy. And it's highlighting that option and that order that's there. And then if you look at JP Morgan, as you've all seen before, the earnings date is the week of earnings is highlighted here. Oh, and then I didn't actually know that. If I put my mouse over it, the bubble shows up there. I thought that only showed up in the portfolio. All right. All right, let's go look at our order on FedEx, and we'll make sure that fills before we leave. 425. Let's put it in at, let's change it. And let's go 475 and hit replace. And then this pops up right here. Do you want to replace the order? It popped up on my other screen, and I say yes. And down in the box, once again, that my head is covering, it shows that we replaced that order. And then up here, it shows that we have the limit right there at 42.75. And then up here, it shows that our limit is now 42.75 right there. All right, no fill. Let's just hit the ask. So this isn't conducive of the real marketplace, but once again, it is hard to fill between the bid and ask on deep in the money, longer term options. And FedEx is not as liquid as NVIDIA or JP Morgan. So it is what it is. Okay, so when we replace it, let's hit the ask. Do you want to replace the order? Yes. Send it to the floor. And there we go. So now we filled because we hit the ask on FedEx So these are two positions there, or two trades there. And here's our portfolio so far. We got 3 positions in, all about the same cost, $4,000 each on all of these. NVIDIA represents the most relative to the stock price. This is the most expensive as far as volatility is concerned, on the $160 underlying relative to the $290 and the $280, which is counterintuitive. More expensive, usually the more expensive these option contracts are going to be. They all have the same expiration date. And we'll probably come back next week and we'll add, I'm going to look at UNH again, see where that ends up at. And then we'll have AI stock. We might get a little bit more representation in there. We'll have a financial stock, and then we'll look at FedEx. Now, in JP Morgan, for example, if you're going into earnings, one way that I would like to trade it, let's say I planned on buying, remember, we're doing this representative of the number of shares that you would buy. So let's say I was going to buy 300 shares. Well, I don't mind buying 1 ahead of earnings and then buying 2 after the earnings. That would be a valid approach, especially if we're dealing with the option contracts and dealing with vol that goes along with it. All right. That's it for this edition of Options Guy TV. We'll come back. We'll look at a couple of other sectors that we'll want to add portfolio positions in. We'll get into earnings next week, and we'll start looking at some earnings trades around underlines that we want to be in. And then I guess, so we'll be back on Wednesday. Earnings won't really be kicking off, like I said, until JP Morgan is really the first earnings that is one of the most important companies that's going to be announcing. And yeah, we'll look at these positions, and maybe we sell. I don't mind selling a call on the FedEx position. Maybe we'll do that next time around. FedEx is going to be announcing when exactly. They're not that far away. FedEx isn't. Gotta go to the charts. FedEx. Yeah, say this is the previous earnings date, but FedEx isn't that far away from announcing earnings either. All right, thanks for stopping in, and we'll see you Wednesday, 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.